right, welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. We'll be taking a look at why IV implied volatility matters again. We did a trade a few months back on Sable Offshore, and it's back, the same setup in SOC. So let's jump in and take a look and see if it works out as well as the last one did. So we always like to kind of do a comparative here, is going back to the last time SOC was at a similar level back on October 31st. You can see the stop did pop nicely on Friday here, breaking out kind of to new recent highs here back to that October 31st level. So we're going to do the comparative from then until now and see how the big spike in implied volatility, IV was down here, has reached an extreme again, setting up ideally for a vol capture trade that can lean with that order flow as well. So here's the implied volatility. I went out 120 days, just going a little bit longer term on this one. You can see that huge spike on Friday in IV, reaching again about the highest level we've seen in the past year. You can see how that versus Thursday to Friday, just a massive run up in IV. IV was hanging right just over 100, got to 177, right? Had reached that a couple times briefly and instantly reverted. We're looking for that to do the same. The nice thing about IV, it normally doesn't stay at elevated levels for too long a period of time, which makes the vol capture strategy even a richer way to approach things. You can see current IV percentile back up to 72%. Considering the VIX is under 15 again, makes it even a bigger jump in IV. Big call and some put volume as well. You can see coming in on SOC across the spectrum. You can see that jump in IV going out in time, right, across the board. And remember, jumps in IV affect longer term options percentage wise in a bigger fashion, price wise. So that's why we elected to kind of go out to Jan, but certainly doing similar trades shorter term, they're just a little more aggressive, right? Makes sense as well. Here you can see the longer look on implied volatility going back 6 months. As you can see, IV now basically the 180-day IV at about the highest level we have seen in a very long time. Here's the last time we came out with that SOC trade on a shorter time frame, right? But you can see that quick reversion. We're looking for that to happen once again. So it's set up ideally for a couple trades. One, a straightforward buy right trade, right, which is simply buying the stock, selling the call. In this case, wanted to give it plenty of room, so, and we have plenty of time, right, out to January of next year. And again, you can use basically almost any time frame and strike you want and get a similar effect. But I compared the January 20 buy right, which is buying the stock, selling the call, back then on October 31st. Remember, it's 1 day later when you look up here. It takes a day to process. You can see that that buy right was going for about $7.50, right? You can buy the stock at around $10.50, sell that call right around $3. So would have paid about $7.50, received about 106 IV on the trade. Fast forward to Friday with that huge run up in IV, you can see the stock is now higher, 1173 now versus 1046 back then. So over $1.20 higher, right? But yet the buy right got cheaper. Why? Because the call price got very expensive. Now trading at just a little bit under $5. Back then, right, a similar call was trading under $3. So you can see that call price, we'll take a look in a second, went up more than the stock in that time frame. Plus, we had time coming off, right? It's from January 2nd of this year, right, going back to October 31st of that year. You'd expect a little time premium decay. So certainly you'd expect that buy right to be more expensive. Stock is higher, right? That makes buy rights usually more expensive, right? Call premiums should come down with time decay. But lo and behold, you can see that buy right actually got 71 cents cheaper. Why? Even though the stock went up $1.27, the Jan 20 call, the one we elected to sell, to basically turn it into a buy, right? Buy the stock, write the call against it. Went up more than the stock did over that time frame, right? From October 31st to January 2nd. So you have the stock up $1.27, the call up almost $2, right? And that made the buy right actually cheaper with the stock higher. We had 63 days pass, right, which normally should make the calls less expensive from time decay. Why did it go up? This huge jump in IV of over 30 vol points. I always like to do the kind of, delta, if you will, right, on the call, right? It went up $1.97.5, right, divided by the stock price went up $1.27. So you would see that the delta on the call would have been a 155 delta. Obviously, you can't have a delta be more than 1. So it just shows you how that huge jump of 30 vol points in IV, right? This huge spike that we saw once again, right? From back here, right? Here was where our comparative was till now, made things so much more enticing for selling options. Then I simply said, okay, let's revert that call price back to a 125 IV, right? Not all the way back to that basically 105 or so IV it was, but just a pullback of about a third of the way back. That call would be only worth a little bit over $4, currently priced at $4.90, right? So that's a very 90-cent or so edge on doing that covered call. Now you get to lean bullishly, right, with all that big call buying that we saw, right? 2-to-1 call volume coming in, and certainly that's a nice way to take advantage of it as well. If you more want to capture vol, don't want to lean bullishly or bearishly, a strangle certainly makes sense too. Again, went out to January of next year, did the same comparative to October 31st. So selling the January 10 puts and the January 30 calls, right? The 10 puts just slightly out of the money back then with the stock at 10.46. 30 calls well out of the money, right, with the stock at 10.46. That 10 sell strangle are just under $5.50, trading at roughly about 100 IV, as you can see, 95 or so on the puts, a little over 100 on the calls. Fast forward to Friday, you can see with the stock moving up a little bit, right, which should be beneficial. Ideally, you want the stock midpoint between 10 and 30, right around $20, right? But because of upward drift and high IV, the delta factor favors the calls having a much higher delta. But we can see because of the huge jump in IV, that sell strangle went from basically just under $5.50 to just under $9, right? Why? This huge lift in IV, IV just exploding, as we said back here, from back then until now, to a level where this is more straightforward capture. You're selling both sides and capturing vol on both sides. So back then, the stock at 10.46, that's strangle, selling the 10 put, 30 call, about $5.50, right? The IV, just a little bit over 100, taking the average of the put and the call IV. The delta on the trade back then, you would have been short 11 deltas, right? Days to expiration, 440. Fast forward to Friday, right? Stock did rally to 11.73, up $1.27. That strangle moved up almost 3.5 points, believe it or not, simply because of this huge jump of over 50 points in IV. You'd be officially about 26 deltas short between the two time frames. Currently, that sell strangle is showing a minus 37 delta, but when you we'll take a look in a second, because if IV drops, that delta will actually soften a bit as well. And again, you had 63 days pass, so you'd expect the delta loss, smoothing the delta, right, taking that 26 times the $1.25 or so move in the stock, you'd expect to lose about 30 cents if you would have sold that straddle, right, or strangle, excuse me. But you would have made money on theta, roughly about the same. Theta, it shows a penny on each side, but it's less than that. So best guess, about a penny a day even, you would have made more from your theta decay, right, your short both options, than you would have lost from that delta move. So we'll call that a net wash. So basically, that huge jump, right, of $3.45 is all because of the IV lift here. And you can see the call when we started back then on October 31st, that $30 call was just under 20 points out of the money, 1954. The put, right, the stock was at 1046, barely out of the money, just 46 cents. Still both are well out of the money. The put getting better, the call still plenty of cushion to the upside, right? And I also took a look and just said, okay, let's do the same thing. Let's revert the IV, not back to where it was before all this started, but about a third of the way back. Move it to 125 on the call, 130 on the put. You can see that would put that sell strangle worth about $7.20. You're able to sell right now for $8.90, so a very nice edge on the trade. And also note too that the delta on the call when you drop the IV is only 46. The put is now about 21, right? Currently, you can see the delta on the put is only 15, right, negative, and the call is 52. So lowering the IV will indirectly move that delta down on the call side, up on the put side, since we're selling both, right? That helps from a delta perspective as well. So hopefully provide some insight how we go about identifying opportunities here, take advantage of implied volatility. And as we say, implied volatility is just a fancy way to say the price of the option. So selling it either in a bullish fashion, leaning with that big call buyer out there, right, buying the stock, selling these very expensive calls that went up more than the stock did, right, or doing a straight file capture trade, selling inflated IV on both sides with plenty of cushion makes sense. So until next time, as always, here's the good trading. Take care.